Okay, so it is recording. Now we're live. Perfect. Ladies and gentlemen, thank you so much for joining tonight's webinar. I have Mr. Scott Nazareth of mortgages.ca joining us. I'm so excited for this because he's really good at what he does. He's not only that, he's also a very good-looking guy, but do not let the looks fool you. He is an absolute savage in the mortgage industry. His team is responsible for hundreds of millions of dollars in mortgages every year. And if you know me, you know I'm a massive fan of using a mortgage broker, especially for investment real estate, rather than going to the red bank, blue bank, green bank, just because when you do go into the green bank, they can only sell you green bank products. But using a mortgage broker is good because they have access to tons of other lenders and credit unions, and also they're working in your best interest. So I wanted to pull some info out of Scott today and hope to educate some people on where the mortgage industry is now and where it's going to go next, and how to navigate today's market. So Scott, if you can, A, how is life going? And B, just tell us a little bit about yourself. Give us a comic book story on how you got into the mortgage game.
Sure. So first and foremost, thanks for having me on, Ken. We've been in the mortgage/real estate business for about 10 years now. Feels like just yesterday we were kind of new, and now after this recent rise in interest rates, it feels like we've been in it for 40 years. So it ages you pretty quick, and things are in constant flux. So as far as recently, we've been fielding a lot of phone calls about the interest rate increases that have impacted all facets of society.
Yeah.
And also from our mutual and separate list of clients who are looking to enter the market as they've seen their pre-approvals be impacted affordability wise with the interest rate increases. As far as myself personally, as Cameron mentioned, my name is Scott Nazareth. So I work with Cameron very closely. We're also very good friends. And I think that additional layer of rapport has created a lot of successful, satisfying experiences for our clients. And we continue to help people achieve the dream of home ownership and also make the transition to a passive investor. So again, happy to be here, answer any questions. And of course, at the end of the webinar, we can always follow up with any particular topics that you want outlined or anything that we may have missed. So looking forward to this.
Nice. Now, before we unpack the whole meat of the discussion and get into things, I wanted to ask, what is your opinion with the Bank of Canada announcement coming up on July 12th? What are the streets saying, and what are you hearing in the grapevines?
Yeah, so I'm going to bring up a chart here. So this is the meteoric rise to interest rates in the past 12 months. So we've seen that interest rates at the Bank of Canada, the overnight lending rate went from 0.25% all the way to where it's at now, approaching 5% within the span of a year. At the side, if you guys can see, the interest rates sort of like a throwback to 2021. It's probably a salt in the wound for a lot of people. 1.5% 5-year fixed, 0.99% 5-year variable. Interest rates today, 5.24% fixed, and 6.3% variable. Now, these are just averages. They change. So I guess one of the things that's important to note is that, there are two major driving factors for what impacts fixed rates. So one, fixed rates are driven by bond yields. So when you take a look at, a 5-year rate and you take a look at a 5-year government bond yield, you'll kind of see the overall trend. But recently, there's been another, important factor to consider, and that's regulation.
Mm.
So in recent weeks, OFC, which is the financial regulator for federally licensed institutions, has increased the capital buffer for banks. So how much funds in reserve must they hold on their balance sheets relative to how much they're lending out to customers?
Right.
What that translates to, not to spew some legalese here, is that the cost of funds are increasing. This means that banks are going to be a little more cautious in what they lend out, and rates are going to be a little bit higher than before due to this capital buffer. So
interesting. That's very interesting. Now I have some clients on the call that are literally in a transaction right now. And obviously given with, I know you don't have any context to the transactions or anything like that, and I definitely know you don't get this question enough, but what are you advising clients these days? Fixed mortgages or variable mortgages?
Just like Forrest Gump said, life is like a box of chocolates. Each and every day, the answer seems to change. And that's really indicative of the narrative changing at both the news media level, but also at the Bank of Canada. So to bring it back to June of 2020, Tiff McCallum at that time stated that interest rates would be low for long. As we've seen, long means something totally different from one institution to another. So a lot of people used to tout variable as the mathematical advantage, because historically variable has beat fixed every time over the past 40 years. We're now in a somewhat of an anomaly where the variable, as you could see at the slide above, is actually higher than the fixed. So from the time I started about a decade ago, I think around the same time you started, Cam, that was never the case. Usually you would have a bit of a spread. So when you're taking the risk on of your payments and rates fluctuating, you still had some savings from day one. Here, if you choose a variable, you're betting that rates are going to go down drastically and fast in order to hit that break-even point. Now, where do you strategically choose a variable? Oftentimes, people will strategically choose a variable when they're looking at the penalty structure. So if you're in a situation where you're going to break the mortgage, i.e. refinance for an equity takeout, or potentially selling the property, you may choose a variable simply because of the mechanics of a 3-month interest penalty versus a fixed, which has an unknown amount of a penalty. So in strategic circumstances, the variable will still outperform the fixed in terms of your total cost when breaking the mortgage. But right now, people are erring on the side of caution. So we're, in most cases, advising clients to choose a fixed rate. They have certainty of payment, peace of mind. And I think a lot of people are still shell-shocked right now from the last 12 months. So the variable is definitely not the most popular option anymore. But that might change. Check in with me in a couple months. The whole situation might be different. That's why it's so important to stay updated and informed with webinars like this, because it can give you a real advantage in entering the market, and also figuring out a good exit strategy too.
Yeah, you know what? I always tell people, like, don't wait for your T4s to come in the mail by CRA. Don't wait for your next paycheck. Don't wait for your next raise. I would go and, like, if you are trying to invest in real estate and you are, or even just buying a home, definitely speak with a professional, and that's your first step in anything. I'm going to get a bit personal. So I know you recently purchased a home, and I'm just trying to get into what type of financing did you look into for yourself, and why? What was your thought process going through that?
Yeah, sure. So when I purchased a home, I used a fantastic real estate agent.
It
Made
was
the
me, by
process
the way.
very easy. He's right up there. And as far as the financing was concerned, obviously being in the mortgage business, I didn't really have to do much else different than a normal day. So I already knew the best rates, the best deals, the best institutions. One of the programs that help as a first time home buyer is the RSP home buyers plan. So
Right.
being able to utilize or maximize your down payment by tapping on different sources. The following year, actually, and what's available for people on the call if they're entering the market as a first-time home buyer, is a new tax-free savings account that's similar to an RSP. Unfortunately, that wasn't available when we were purchasing,
Right.
but we chose a fixed rate to answer your question about the specifics there. And at the time, we were, if you look at end of 2022, people were calling for rate cuts.
Right.
People were, anticipating the conditional pause. So it was quite, it wasn't a very popular decision at the time as it would be now. But in hindsight, rates have already, like fixed rates have already gone up by
Right.
50 or 60 basis points. So sitting pretty at the moment, but not too sure what's going to unveil itself for the rest of the year. I guess we just have to wait and see.
Yeah, played it safe with the fixed rate. I think that's a strategic move, honestly, especially nowadays. I think and also like you said, fixed rates are higher now. Let's gear the conversation more towards the self-employed people on this call, because I know there's a lot of my clients that are self-employed, and I speak to the self-employed people only because I know there's specific programs that maybe you would know of for them. Only because I know a lot of the self-employed people, they don't like to show their full income when they're reporting taxes. Not saying I know people like that, but I just know it happens through the grapevine. But if you can speak to the programs that you would have or how you would navigate that type of client.
If the CRA is listening or there's any auditors, we do not advocate for any sort of tax schemes or strategic, aggressive tax planning. But a reality for a lot of self-employed people is that there are options at their disposal. So that varies a lot from a small-time business owner that has a mom and pop shop to a large business owner that has seen their business expand from one employee to 100. So the mechanics of that are typically discussed with an accountant. But as far as programs are concerned, a couple of good ones that come to mind. Number one, if you are a professional, and what I mean by that is if you're a doctor, lawyer, engineer, and you have a professional corporation where you bill your clients or you bill hospitals or what have you, you may have a written down income relative to your total gross and the funds that you keep in your corporation, your retained earnings, might be more indicative of how much money you actually have at your disposal. So through a couple of big banks, we do have a specialty program that allows you to add those retained earnings to your income in some capacity and increase the amount that you can qualify for. Now, for let's say a mom and pop renovation company, just under 10 employees, cash business, you can use a stated income program from one of our B lenders or credit unions. And B lenders, for whoever's on the call that may not be familiar with the lingo, is one step below a Schedule I AAA bank. So not a private lender. B doesn't stand for bad by any means. It is more so out of the box solutions for specific cases. So for example, if you are a contractor, you receive a lot of funds in cash, you pay your employees the day of in cash. Some of that stuff may not be necessarily captured in the tax return. So these programs will be able to hone in on that specific cash component and allow you to actually state your income. The way they do this is they'll take a look at your bank statements and they will annualize the gross figure from your bank statements in order to capture how much revenue you're bringing in. They're going to use a reasonability test based on your industry. So you're not going to be able to use 100% of your gross income, but you might be able to use 70% or 80%. It has created opportunities for people who otherwise thought they couldn't qualify, get into their first home, buy their first rental property. It's been great. So knowing that there are options on the table is the first hurdle. Sometimes people will go to their bank, get declined, get dejected, and then either, stick to a certain mindset or, sort of relish in the fact that home ownership or being an investor may not be for them. We're here to tell you that that's not the case. There are options, and, we have them at our disposal.
Interesting. So at what point does it make sense because a self-employed person at tax time, they have sort of a problem. It's either they write their income down as much as possible to save on tax, or they don't write their income down because they're actually planning on purchasing a property and pay more in tax. So at what point, because I know the Schedule B banks, they have higher rates than the Schedule A banks. So at what point would that make sense for someone? Is it just simple math that you would put on a file like that?
Well, I mean, for any tax advice, definitely an accountant would be the best person to ask. But as far as, on a general level, how people make these decisions with that advice, they'll look at, how much money they're paying in tax.
Right.
It could be, round figure, it could be like 60, 70,000. And they'll look at what the rate premium and additional cost would be for these sorts of programs. So for example, if you're looking at a rate of 5% at a TD bank and you want to qualify for this program, you might be looking at 5.5% and a 1% lender fee. So lender fees do become a thing when you're qualifying for these specialty programs. As with the additional risk, there is a risk premium. But people will typically look at that as the cost of doing business. You can't have your cake and eat it too. You can't not pay the government, not pay the banks. The one who has the gold has the rules. So it's important to, sort of pick your poison. And that might be something to speak to your accountant about for sure.
That's interesting. Okay, thanks for clarifying. And so I have a lot of investor clients on the call, of course, because this is a real estate investment webinar. Some of these guys, they're addicted to the game. They have 5, 6, 7 properties, but they can't just walk into the bank and get like a loan for their next investment property. Can you get into why they can't actually just walk into the bank? And can you also get into what type of tactics you'd use with a client like that?
Yeah, sure. So each bank that are on like the top 5 most known banks in Canada will typically have a limit of 5 properties that you can own as an individual residential investor. Okay. It's important to note that lingo means everything. So some banks may have a limit on doors, some may have a limit on units. Or properties rather. So for example, a duplex might be treated as 2 doors at one bank and treated as 1 property at another institution. So knowing the specifics definitely helps. Working with a mortgage professional can help you with those intricacies. You're not banging your head on the table after you've actually made a purchase. But most of them are 5 as a limit. We do have a specialty program with one of the top 5 banks where we can actually go up to 10. Now, this is not something that an individual can walk into a bank and get because we are top 20 with this bank in Canada. We are able to offer this to our clients exclusively, where you can go up to 10 properties with a Schedule I AAA bank, top 5 lender in the country.
Okay, so
but as far as the other aspect of it, so let's say you've reached that threshold, right. What are your options?
Yeah.
So there are options at credit unions and insurance companies where they will take a look at individual exposure versus total amount of properties that you own as an individual. So for example, if you have 5 properties at Scotiabank and you go to Credit Union A, they may limit you to $1 million or 1.5 million of exposure at their bank and not take a look at the exposure you have at other institutions. So that might allow you to, receive 2 or 3 properties under one credit union, and then another 2 or 3 at another credit union. Sometimes spreading it out is great. If you want to stick with one individual institution, sometimes you can be, looked at under commercial lending guidelines, which is a bit different. It is looked at as more of a business case. So to just speak to that briefly, for commercial loans, they'll take a look at your corporate profile. So number one, how many properties have you managed? How well are they doing? What's the monthly cash flow? What's your profile as an owner? So what are your what's your income, your liabilities, basically your balance sheet, like you would look at any individual company. And then they would determine how much leverage they're willing to extend you. With commercial loans, typically those are reserved for professional investors or investors that have hit the cap, or for properties that fit outside of the scope, like you're purchasing an industrial property, agricultural property, high-rise, something, kind of massive. Right. In that case, they will typically scale back the loan to value, as you're not going to go, 80% on a office building, whereas you might go 80% on a single family home or a condo. So there are drawbacks in the sense of loan to value. If you're an individual investor, you might want to hit the quota or hit the cap at a bank first, and then explore the credit unions before you start to go into commercial lending, because you'll be required to have more of a down payment. Rates are a bit higher, and it's a little more difficult to qualify.
How is it more difficult to qualify for a commercial loan?
So, for example, if you have, let's say, a property that's worth, 1.5 million,
yeah,
and you're looking at a commercial loan, they'll take a look at 50% of the rents. They'll factor in a vacancy rate, whereas for a residential purchase as an investor, you can use up to 80% of the rent to offset ongoing costs. So they look at it with a much larger lens for potential risk. So things like marketability, things like depreciation of time value, if the property is in a market that might be declining in their view. So it's more, there's more to it to qualify for sure. And usually, it does require a bigger down payment. So for example, if you're refinancing an existing property, you're going to have to pay the interest on the additional amount that you're going to be borrowing. And things like market rents, which we haven't gotten into yet, but for people on the call, market rents are a really cool way for individual investors to actually qualify based on projected rental income without having a tenant in place. So for commercial loans, that's not a thing. So there's small levels of uncertainty that are okay for the risk profile of an individual residential investor that on a commercial basis might be not looked at with such favorable eyes.
Interesting. I know there's some people on the call, they either don't have an investment property yet, thinking about wanting to get an investment property, or they just have a primary residence that they want to potentially tap into their equity and buy an investment property. Can you unpack how you would help a client do that by tapping into their current equity that they would have in their primary residence with a HELOC or a home equity line of credit or a refinance?
Yeah, sure. So home equity line of credit is a great tool in order for people to be prepared for entering the market, whether it be for a second home, a cottage, an investment property. Essentially, what it allows you to do is lock in today's value and have it ready in the form of a credit facility, i.e. a line of credit, that you can borrow from when you need it. So unlike a mortgage where once the refinance transaction is complete, you receive all the funds in a lump sum. With a HELOC, you start off with a zero balance, which means that you're not paying interest from day one just to access the funds. So if you are looking to enter the market, you have equity, you want access to that equity when you want to pull the trigger, then a HELOC is a great way for you to have that available. Secondly, if you have a mortgage and you've gotten it in the last couple of years, you're not going to be, willing to let that go very easily, to say the least. I mean, you might be at sub 3% rate. Today, rates are above 5%. So a HELOC is also a way for you to not trigger a penalty and break your existing mortgage, as it can be a second position loan that you can put behind your first mortgage, and you can keep the exact same interest rate that you have. So it's a pretty popular tool. And if you think that the market might be going down, it's never a bad option to lock in on today's value.
Right. So basically the HELOC is like almost like a prepaid credit card that you would have that you can use at your own timing. You might not have a property in mind, but at least you would have the capital that you would have access to.
Well, actually, for pre-con, I'm sure a lot of your clients use home equity lines of credit.
Oh, yeah.
The deposit structure is not all at once. So maybe you can speak to how that helps.
Yeah. So the deposit structure usually on pre-construction, as an example, obviously all deposit structures are different. But what I've been seeing in the marketplace usually is about 5% a year. So you're paying a total 20%, 5% a year. The condo is then built in like year 4 or 5. So I guess a HELOC, which a lot of my clients use, they can pull out the deposits at their own leisure when it's due. They can sit on the money, and the money's not, they don't pay interest on the money yet until they obviously pull it out. So it's a great tool to use. One question though for you is, why would one use a refinance over a HELOC?
Yeah, so that's a great question. Typically, refinances are done for a variety of different reasons, but with the rising interest rate environment that we're in now, it's kind of fit itself into the box of just being strategic. So imagine you have like a 1.5 2% rate, and I don't think you're going to be thinking of refinancing to get a 5% rate just to save some money. I mean, the only time that you're actually going to go through and break that mortgage is in the event that you're looking to do some debt consolidation, or you have a property or investment in mind and you know exactly when you're going to need the funds. In that event, yes. So for example, if you have leases, car loans, student loans, lines of credit, all of those liabilities are impacting your ability to qualify and what purchasing power you can actually obtain. So in the event that you want to consolidate it into one payment that's amortized over, let's say 25 or 30 years, your monthly outgoings will be reduced and your purchasing power will be higher. If you're not in a situation where you have all these liabilities, then in most cases you wouldn't refinance into a higher rate. Unless, like I said, you have an investment coming up, or you have a known use for the funds as they come in the form of a lump sum. And in that event, you can look at what the difference in cost would be for a HELOC. Let me see if we have the math here. HELOC versus a mortgage. So for example, on a HELOC, it's a variable rate. Number one, usually it's prime plus a half, prime plus a quarter for our clients. For a mortgage, it's always at least, anywhere from 75 basis points to 1% lower. And it's amortized over, 30 years. So if for $100,000, if you take it out in a mortgage based on today's rates, it's about $550 a month. If you take it out on a HELOC, it is $625 a month, interest only. So the other aspect of HELOCs is that the minimum payment is interest only. Whereas with a mortgage, it's principal and interest. So if you're paying into a mortgage, you're paying down the balance. If you're paying into a HELOC at the minimum, you're only covering the interest.
And
Now,
these are at today's rates, right? Like
sorry?
HELOC, 625 a month, mortgage 550 a month. These are at today's rates.
Yeah, these are at today's rates. Yeah.
It's still affordable. Like I've seen guys spend $625 in one night at a bar. So, and I'm not one to say where you should spend your money and not, but it is still affordable, I would say.
Yeah, I mean, if you're looking at your savings each and every month, typically people are saving, anywhere from $2,000 to $3,000, or let's say, 10% or 15% of their income, obviously relative to their income. And if they take a chunk of that to invest, they can definitely, be very thankful in retirement when that property is paid off and there's some passive income. So it's still within reach for people who qualify, which is great. But as we always discuss for new entrants to the market, it is becoming more and more difficult to qualify. So the slide above, first time home buyers, people are buying later on in life. So people at 18 to 25 back in the day, saving over a summer and being able to start their family early and stuff. That's been pushed out. The amount of immigration that's occurring in Canada is steadily rising the population. And as you always sort of tout, the supply issues are still prevalent. So
Yes.
We have people coming into the party and not enough vendors to serve them. So that means it's very bullish. And then with the mortgage rule changes that we've seen over the last 10 years, specifically, the stress test, the foreign buyers ban, a whole slew of ratio changes, limits to amortization, limits to down payment. It's becoming more and more difficult for new entrants to qualify. So as an investor, as a potential landlord, or as a second or third time landlord, this is very bullish as far as the rental market is concerned. You were telling me the other day, Cameron, that a couple of your clients have faced landlords asking for 12 months of rent up front. Isn't that like a down payment or something?
The rental market is very competitive right now, especially when you get into like between July and September, October, when all the students are coming from abroad. These students are simply like they have expectations of prepaying minimum 6 months rent, and I've seen usually it's 12 months, like a year up front. Which makes the market interesting, especially for the people that are from here, because that's their competition, and that's who they're in the marketplace with. People that are coming from abroad, and they're paying 1 year up front. Of course, landlords are going to favor these people, so it's getting very competitive, which is a massive opportunity for people looking to invest in properties, because the rental market is so competitive and crowded. And I see a lot of potential for rents to increase. What's interesting is rents outside of the city are very similar to rents inside of the city. So if we're looking at like a place, for an example, like Oakville, just to use that as an example, the purchase price in Oakville, and you can talk about the resale or pre-construction market, both markets, it's about $100,000 cheaper for a 1-bedroom condo in Oakville than Toronto. However, the rents are very, very close. Like you rent a condo downtown Toronto for about $2,500 a month. In Oakville, it's like $2,300 a month. So it's only really a $200 a month gap, approximately. I think there's a massive opportunity there, because there's actually a big difference in price tag. As the city gets smaller and as infrastructure is built and new transit is included in the city, I think it's making things very lucrative for landlords these days. So, quick question: the slide that you had up? What does $100K cost in a HELOC? So so someone pulls out $100,000 in a HELOC. It'll cost about $625 a month. But just to clarify, they don't like they can. Let's just say their HELOC total is $100,000, and they only need like $30,000 for a deposit. Can we assume like it's about 30% of $625 a month? Is that what it is?
Yeah. So with a HELOC, you can borrow as much as you need whenever you need. The $100,000 figure up there is for the entire 100,000.
Right. Okay. That's so yeah. So that's it's a great option for people looking to invest, especially in pre-construction, because you don't need the full cash up front.
Well, you know what's funny on social media, especially Instagram, you get so many of these ads that come up for pre-construction, and sometimes they're from the builder, sometimes they're from realtors. You don't even know where they're from. Could just be a lead page of some sorts.
Yeah.
But one of the cool things that Cameron has done for his clients is get VIP access through property.ca, through his own connections. And that kind of changes the scope of when you're able to get in, when it's released to the public. And there's sometimes some favorable clauses in there too, related to upgrades and stuff like that. What are the advantages, Cameron, of going through a realtor versus directly to the builder for purchasing pre-con?
Yeah, that's a good question. So most pre-construction developments, you actually can't go directly to the builder. Just simply because they don't have a sales team in place. So that's number one. Number two is they don't offer the builder itself. Sometimes if you go directly to them, they're not going to offer the same incentives they offer if you were to go through a real estate agent. So some incentives that I look for is things like you can lease your unit during a phase called occupancy, where you're making cash flow.
And what is occupancy for the people that don't know?
Yeah, so occupancy is a phase in the development before registration. So before the condo gets registered with the city and passes the bylaws. So there's an occupancy date that purchasers are given, where they're on that date they're allowed to start renting their property out. But most importantly, they're also charged an occupancy fee. Usually the occupancy fee is market rent.
Oh, okay. So market rent, is it, so usually people cash flow off that with their first tenant, or?
Yeah, you would hope so. Or at least break even for sure. Because the market rent the builder charges you, it's
conservative.
Sorry? Yeah, it's conservative. Exactly. So it's a little cheaper than market rent. So yeah, like 2 bedrooms, they might charge you downtown Toronto, they might charge you $3,500 a month, but really you could rent that out for like $4,200 a month. So it's a good time that you can make a bit of cash flow. It hopefully doesn't last long, because that occupancy fee is not going towards a mortgage. It's just going straight to the developer.
And one thing that we've noticed as well is that I don't know if it's probably somewhat indicative of COVID. But there have been a lot of delays in buildings actually reaching the registration point. Have you faced any delays in the last 3 to 6 months, or is that kind of behind us now? What's the outlook for these properties actually closing and registering?
Yeah, so the construction industry in itself is it's going through a different time, only because the labor market is different now. So they're struggling finding people actually working for them. So there are a lot of delays right now in the construction industry. Could be a good thing for investors, because, like I said, a lot of these pre-construction investors, they want a hands-off investment. So even if there is delays, they're still making capital appreciation as the market goes up. And they're not paying a mortgage at all. It's just simply deposit outlays. So
that's a good point. As you're waiting, technically everyone's in the same boat. So it's not as if you're waiting and there's condos coming up all around you and supply is increasing tremendously. So constrained supply increase and pressure on price growth moving upward. So that's a really good point.
I sent out
applying for your first investment property. It's the same process for residential mortgage application. So you look at income, you look at liabilities, you look at your credit score. So on average, people will want, or banks will want, about 680 and above for an investor. Can be as low as 650. If you've had issues with your credit in the past, let us know. It's always good to know where you stand before you take the next step. And sometimes we can clean up stuff, but aside from the credit score, it's pretty standard as far as income confirmation. A couple of cool things that you can do, as I alluded to earlier in the call, is that you can actually utilize market rents. And I think you mentioned that earlier with the occupancy period, is that you can have an appraiser go in, take a look at the value of the property, take a look at the market rents, and you don't need to rush to get a tenant. Which is great. Some lenders allow it, some don't. And in some cases where you're purchasing a resale, you might be assuming a tenant. So that might be a whole different scenario. But in the event that you want to take your time, you want to vet the tenants. I know that Cameron has a pretty amazing 9-step process to ensure that you have a good tenant in there. There's a lot of fraud out there in the residential rental market, and we've seen it firsthand. They're very sophisticated. These things do happen quite often, and working with professionals allows you to sort of have your ear to the grindstone, and people in the trenches to know what to look for, what to look out for, and put you in a good position to go for your second or third investment property later down the line. So
Yes.
what sort of things have you seen as far as, fraud on applications, or any tips for new investors on what to expect? Should they get a property manager, things like that?
Yeah. So there's for smaller landlords, there's tech out there that they can sign up to vouch for tenants.
Oh, cool.
Yeah, on their end. If anyone wants their hands on any of the tech, you can feel free to email me. I go through personally a 9-step verification process. I think the most important thing that people have to watch out for is fake documents. They're easily editable. Also, in Ontario, at least, it's weird that when the tenants, they go to apply for a rental unit, they supply their own credit report. I think that's kind of backwards. What I do. Yeah, it's very strange, and it opens people up to a lot of fraud. So what I suggest people to do is add a clause in their agreement saying that you're actually going to pull the tenant's credit report, get their ID, get the credit report that they pulled themselves, pull something on your end using the same credit bureau they used, and see if everything matches up. And not only the score, like you got to look at the full credit history, because if anything doesn't match up, it definitely would seem a bit fishy.
Yeah, it's crazy. I just pulled up a chart above here. The amount of new people that are coming to the country is
Crazy.
Looks like a chart of Bitcoin, actually, more so than immigration. But it is a policy of the liberal government to bring in more people, and that's very bullish for the rental market, for the real estate market in general. So as far as outlook is concerned, there's going to be doom and gloom always on the news, whether it be about interest rates, whether it be about war, politics, what have you. We won't be able to speak to all of those things, but what we can do is, put you in a position where you feel comfortable, you feel safe, you're making informed decisions with all of the facts. And webinars like this allow you to stay updated in a market that's constantly changing. So the information today, or today's price, is not necessarily tomorrow's price. Really is true, because things can change. We're going to have a rate announcement in July that really has moved from a sure thing to a coin flip with the latest inflation data that's come out. So, all bets are off at this stage. I mean, I would predict that we're probably going to see a 0.25 percentage point hike, but we'll see. What about you, Cam?
Yeah, I mean, they basically promised the last hike that they're going to hike again. So if I were to put my money on anything, I think I would say it's probably going to be a hike, at the least a pause. Hopefully,
You
it's
already here.
hopefully it is a pause, but it might be a hike. So we'll see what happens.
Yeah, fingers crossed. Fingers crossed that we'll see finally some sort of stability. It's been a whack-a-mole situation, on and off, on and off, and it's difficult. But in times of uncertainty, it's the best time to work with professionals. And when people are nervous, scared, extra cautious, that's usually the time that investors make the biggest amount of profits. Because they're able to navigate through those murky waters a little bit better than the average person that might not be willing to jump in. So getting your feet wet in these sorts of waters, so to speak, can seem scary, but working with experienced professionals will make it easy and make it very profitable too.
Brother, thank you so much for joining me on this call. I want you to, for my people at least, I want you to show them how they can get a hold of you in case they want to look into getting a mortgage or plan for the future.
Sure. So it's very easy. I work at mortgages.ca. So my email is scott@mortgages.ca. Phone number is 647-795-8700, extension 104. And of course, if you want to get in touch with both of us, reach out to Cam. We'd be happy to help. We have a long list of very satisfied, happy clients that have worked with both of us. And honored to be here. Thanks so much, Cam, for having me on. It's great that you want to provide as much value as possible and insight to your database of clients and also to mine. And always happy to help.
Absolutely. Huge congrats to you and your team. I know you guys are killing it, doing big numbers. For my people, feel free to reach out to Scott. You know how to get a hold of him. Thank you so much for joining tonight's webinar, and we'll talk to you later. Cheers.